this is a practice test for your first accounting class. In order to do well on this test, you will need to understand the accounting equation. Click the link in the video description below to watch a tutorial made by me on the accounting equation. However, I will just remind you of what the accounting equation is. So asset should always equal to liability plus equity. That is the accounting equation. For that reason, asset always has a debit account. So our asset has a debit account and liability has a credit account and equity has a credit account. Okay. What that means is asset increases with debit. So whenever an asset increases, you will do a debit entry. So on your T account, you may have a T account. If it's an asset, it has to increase with debit on the left-hand side of the equation. If it's a liability, it has to increase with credit on the right-hand side. And equity increases with credit on the right-hand side. However, there are some accounts that decreases asset, okay? And because asset increases on debit, any account that decreases asset will go on the credit. Accounts like accumulated depreciation, okay? It's a contra asset. Contra means it does something contrary to what a normal asset would do, and that it decreases asset, so it has a credit account. We have equity here. Equity always has a credit entry, that is, it increases with credit. But we have as accounts that decreases equity. Those accounts are expenses. Because expenses decrease equity, it will have a debit account. Although equity has a credit account, expenses will have a debit account because it decreases equity. Think about it as a contra equity. Okay, it decreases equity. Okay, so let's move on and solve this problem we have here. So keep calm and practice review for the test. So we have this situation that we need to figure out what it is. Okay, so it says here, journalize. We are going to journalize, okay, a transaction. So that is a journal entry. We are going to do a journal entry. Okay? But for you to be able to do a journal entry, you need to understand the transactions. Okay. And I want to tell you this. Whenever you are doing a transaction and you hear or you read the description says on account. Okay, this word, if it is in your description, okay, you have to know that you are going to deal with two accounts. Okay, you are going to deal with either account receivable or account payable. Okay, whenever you hear on account, just think it's about account receivable or account payable. Okay, under what circumstances will it be account receivable? If you sell something, that will be account receivable. That means you have sold something on account and you are waiting to receive the money. That's account receivable. If you buy something, that is account payable. You have bought something on account, you haven't paid it yet, and you are waiting to pay it later. So this becomes a liability and this becomes an asset because it's money that you have. So pay attention to that. Okay. There is another word that you may hear in your descriptions. Whenever you hear bill, okay, bill. Bill also deals with account receivable and account payable, okay? Under what circumstances will you know if it's account receivable or account payable? It's the same concept. If you do a service for a company, okay? So if either you sell or do a service. If you sell or do a service and you send a bill to your customers, that becomes account receivable because you are waiting to receive the money from them. You just send them the bill like, hey, this is how much you owe us, so you should pay later. Okay, and if you receive a bill, okay, so you receive a bill, that becomes account payable because someone has performed has delivered goods or services to you that you are liable to pay for that. Okay, so you can tell with our first one, we have what we call account receive cash. Okay, that's not, but we have a bill here. Okay, bill customers on account. Okay, so we have done a service and then we are billing the customer, so we are waiting to receive the money later. Okay, I hope that makes sense. So we'll go ahead and figure out where these things go. Okay, which account to journalize. So I have my journal entry set up here. Okay, but I'm going to move this here so we can see it side by side. So you need to do something like this. You have your journal entry, it has to have a title. This is where the date goes, the column where the date goes, the description, what it is, and also debit and credit, whether it goes to debit or it goes to credit. Okay. So in our first problem or in our first transactions, it says we receive cash. Okay. Make this a little thinner. So we receive cash. So we know we are receiving cash. So the cash account is doing what? Increasing. Okay. So our cash account is increasing. So what side of the accounting equation, or does a cash increase with debit or credit? It increases with credit. Okay. So we know we are receiving cash. Okay. But there's an investment by owner. Okay. So whenever an owner makes an investment, the owner's equity increases. That is the capital. Okay. The owner's increases, equity increases. That's the capital. So we are going to do this transaction on April 1st. We receive cash, the company received cash of 14,000. So the company's cash is increasing an amount of 14,000. So you tap the cash, you tap the equity, or the capital and the owner's name. Okay. So we will know which of the owner is. As you progress in your accounting classes, you will realize that we don't actually have just one owner. There are some companies or enterprises that you have more than one owner. So you need to indicate which owner or which shareholder owns that portion of the equity. Okay. So then as you put your 14,000 here, because credit should always equal to debit should always equal to credit, you will just need to reference it. So you press equal sign, and then you reference it. So we have 14,000 on the debit side and the 14,000 on the credit side. Okay. So we're done with number one. Okay, so let's move on to number two. So number two, it says we receive cash for providing service. So we know cash is increasing again, okay, for providing accounting services. So this company is an accounting service. They provide accounting services, okay. So because we have provided it, it's a revenue. We have earned it, okay. We have what we call merchant principle or a revenue recognition, okay. The revenue is yours only when you have performed the services. Okay? If you haven't performed the services, you haven't earned it. But in this case, we have provided a service, so we have earned it. So our cash is increasing, and then our fees earned or revenue will also increase. Okay, and cash increases with debit, and revenue increases with credit. So the accounting equation will balance. Great. So we have our cash increasing by 9,500, and then our fees earned will increase by the same amount, so we will just reference it, and we have this. Okay. On the third one, we bill customers on account. Remember what I did here? Bill customers on account. Okay, because we have billed customers, we have sent it out, we are going to have account receivable. Okay, so we have account receivable for providing services. So we have earned that thing. We have earned that amount because we have provided the service. Okay? So it is ours. So we'll do the same thing we did here, cash and account receivable, because we haven't received the cash yet, and then fees earned. Okay. So we have account receivable increasing by 4,200. And then we just reference it because we want debit and credit to be equal. So reference by 4,200. So we are on the fourth one. Okay, paid advertising expense for 700. So what is happening here? Okay, one thing you also need to pay attention is whenever you hear paid, okay, paid means cash is going out. Okay, so we know our cash is going to decrease by $700. But what are we paying for? If our cash is going to decrease and it's going to be on the credit side, what account should we debit? What are we paying for? We are paying for advertising expense, and we know expense is always debit. Okay, so we're going to do that as well. So we have our advertising expense and we have our cash going out. Okay, so $700, and then we'll just reference this one to that. Okay, good. The next one we have receive cash from customers on account. Okay, so what is happening here also is that we have a customer that we have billed, okay, that we are expecting to receive money, but the customer is paying some amount. Okay, so just assume that this customer is paying 2,500 out of what we have billed. Okay, so what will happen is we are reducing the account receivable and then increasing our cash. Okay, so if we are reducing the account receivable, that means our account receivable should have a credit entry to decrease it. Okay, because account receivable increases with debit, so it has to decrease with credit. Okay, so if you have your T account here, okay, if you have your T account here for account receivable, it increased with debit. Now we are decreasing it. Okay, so we have to do it increased with debit. Now we are decreasing it, so we have to do a credit entry. Okay, so this is what is happening with this problem. Okay, so we will do just reveal this. We have our cash and then account receivable decreasing. So cash, we receive a cash of 2,500. And then we'll reference it. So we have both sides of the account equal. Okay, so and then on this number 6, we have owner's equity. Owner withdraw equity of 101, so 1010. Okay, now that is a withdrawal. Okay, withdrawal is always withdrawal. Okay, owner is withdrawing this. Okay. But what is the owner withdrawing? The owner is withdrawing cash. So that means our cash is going to decrease by 1010, and then owner's withdrawal is going to increase. We want to make an account of the money that the owner has withdrawn. Okay. So we'll have the drawing of 1010, and then we'll just reference it. So we'll have on both sides of the equation. Now, quickly. So we have received telephone bill. So that's where the bills come in. We have received a bill. We didn't sell. So because we have received a bill, we have to pay it later. Okay, so that becomes an account payable. And we know account payable increases with credit. Okay, so this is a utility expense. Okay, this is a utility expense, or you can make a telephone bill. It's up to you, but it's a utility. So because it's an expense, we're going to debit that expense and then credit account payable. So we have 900, and then we're just going to reference that 900. So we have to have it on both sides of the equation. Okay, quickly. The last one, we paid. Now we are going to pay the telephone bill. Okay, we're going to pay the expense. Okay, now here you don't do anything with expense again. Once you have recorded an expense, you have recorded it. You don't do anything with it. You only pay it. So you ask yourself, what is going out? My cash is going out of 900 because it says paid. That means cash went out. Okay. And then what I used to owe, okay, you were owing 900,000, will also go down. You get rid of that. So that means you're going to debit account payable to get rid of the 900. So usually student will go back and do an entry for utilities expense again. No, well, if you do an entry again, that you are overstating your utility expenses. Okay, so you shouldn't do that. So what you do, account payable, we are getting rid of it for 900. Okay, and then our cash is going out with the same 900. Okay, and as you can see, my total check, we have the same amount because I just sum up everything here together. We have the same amount here and we have the same amount on the credit. So that means we are right. We did something right. Okay, good. Great. Good luck on your test. Let's go to the next one. It says 11. Says on April. So we have this on April, a business first year. Sorry about that. We have here the business estimate depreciation. So we are dealing with depreciation, okay? So we know depreciation is an expense. So we know it's a depreciation expense, okay? On equipment. So it says you the specific equipment. You need this so that you will know which account will accumulated depreciation go against. If this were to be tracked, okay? If this were to be tracked, your accumulated depreciation will go against track. So we know we always have accumulated depreciation and then the equipment, okay, or the asset, okay. But because this is an equipment, your accumulated depreciation, you know, is against equipment, okay. This for the first year is 2,900, okay. So we are going to journalize that for April. So I'll move this here so we can see it side by side. Okay, so what are we going to generalize? We have a depreciation expense, and then we increase that by debit, and then increase accumulated depreciation by credit. So we have here, so you need to, whenever you do this, you need to indicate which accumulated depreciation it is, which contra asset is it. Is the contra asset going against equipment or track? It's going against equipment. So you have your equipment here. Oops, I didn't spell the equipment well. Okay, you have your equipment, it's accumulated depreciation for the equipment. Okay, the estimate 2,900. So we have 2,900 as an expense, and then we're going to credit the same thing right here. Okay, so this is our journal entry. Okay. Number 2, it says, what does it say that I don't see? Okay, that's A, we did A. So it says, if, that's B, if the adjacent entry in A were omitted. So if we didn't do the adjacent entry, okay, which items will be erroneously stated on the income statement for the year and also the balance sheet? Okay, so we know when you think about the balance sheet right now, you know that this account, accumulated depreciation, goes on the balance sheet. Okay, so if we don't do it, that means accumulated depreciation will be understated. Okay, if accumulated depreciation is understated, then what we call our asset will be overstated because accumulated depreciation decreases our asset. Overstated means we have a higher amount than we're supposed to. Understated means we have a lower amount than we're supposed to. So because this is understated, we have asset here, and then we have accumulated depreciation. Okay, this one decreases this. Because we didn't decrease this, if we didn't do the entry, this is overstated. Okay, we have more than we're supposed to. And because it did not decrease this, or this is understated. Because it did not decrease this, this is also overstated. Okay, so accumulated depreciation will be understated, and then asset will be overstated. Now, when we go to the other side of the equation, as I showed you here, on the other side of the equation, we don't have anything to do with liability, but we have owner's equity because expenses decreases owner's equity. Okay, so what did we do with expenses? Expenses will be understated because we didn't record it, so it's understated. And then owner's equity will be overstated because that did not decrease owner's equity. So the expenses will be on the income statement. That's what will be understated. And then equity will be on the assets. That's what will be overstated. Okay. So with our next one, we have a pretty long problem here. So here we have what we call the trial balance. Okay. So we have the trial balance, we have everything here, what it was. So you always begin with unadjusted trial balance and you make adjustment. Okay. So adjustment means you are changing numbers to adjust it. So you are either adding numbers or reducing numbers, or you are either increasing cash or reducing cash, or whatever account that you have been given that you have to. Okay. Because at the end of the period, you realize that you use something that you need to record. So you are just recording something you didn't record throughout the period. That's what the trial balance gives us the opportunity to do. To adjust it so we can have adjusted trial balance. Okay. So with these all figures that we're going to do, I have made a template here. Okay. So this is how you do your template. Okay. So those are the same numbers, okay? But with A, it says unrecorded depreciation on the track is 88. So we're going to find out later, okay? But I'm just showing you how you should do it. So you should have the company's name, you should have the name of the trial balance, and for the year ended, because that's the end of the year, okay? And then you have all your accounts. So everything here should be unadjusted, okay? That means we need to make an adjustment. And I've colored this one so you will see the difference, okay? We have the adjustment here. And then this is the adjusted trial balance. After we do the adjustment, we are adjusted. And we have income statement and balance sheet. I will tell you which account goes to income statement and which account goes to balance sheet on the trial balance. Okay. So with here, you should also have another total check below it, okay, because you are going to make adjustment here as well. If you have a net income, that will increase. If you have a net loss, that will also decreases, okay. So you need to, so but you'll find out as we get there. Okay, so with number one, what does it tell us to do? It says unrecorded depreciation on the track at the end of the year is 8,500. Okay, so we are going to increase depreciation. Okay, and once we increase depreciation, we are also going to increase accumulated depreciation. Remember, this does not change. Whenever you increase depreciation, you have to increase accumulated depreciation. Okay, it never changed. That is what it is. Okay, so we have of an amount of 8,505. So let's go and look for depreciation. Okay, says depreciation on the track. Yep. So let's go and look for depreciation on the track. We are going to increase it. That's a debit side of 8,505. Okay. Now we are going to increase accumulated depreciation on the credit side with the same amount. So let's look for accumulated depreciation right here. This accumulated depreciation here. So we are going to increase it by the same amount, but on the credit side. Okay. So we have that one figured out. Good. Now, the next one says the total amount of accrued interest expense at the year end was 8,000. Okay. Accrued means let me use this. Okay. So this one here, interest expense. Okay. So we have incurred something that we haven't paid it yet. Okay. So we have incurred interest expense, but we haven't paid. So that will go into account payable. Okay. So we are going to record interest expense, okay? But because this one is specifically tells you that it's an interest, so if you have an account called interest payable, then you will have interest payable. If you don't, then you will record into account payable. But you want to know what specific account it is. So this one we probably have been given, so we'll go to interest payable. That means we have interest that we have to pay in the future. So we'll go back here. What was the number? 8,000. So we look for interest expense. So this interest expense is increasing. So we're going to adjust it by increasing it by $8,000. Okay. And we need a same account, okay, to have a credit balance or credit account. So we have here, let's look for interest payable. Okay, so it should be in the debt in a liability portion. So interest, these are interest payable. So we're going to credit that by the same amount. Okay, so just reference it. So 8,000. So these ones are equal. So we know we're doing something right. Okay. The next one says the cost of unused office supplies still available at year end is 1,100. Okay, good. Now we have 1,100 left. So what we are going to find out is how much did we use. Remember, expense means used, okay? Whenever you hear expense, it means used. So how much did we use for office supplies? So we are going to find out the beginning office supplies and subtract what is left. That is how much we use, okay? So we make the analogy. Okay? If you go to the market and buy 10 apples and you put it in the fridge, okay? The following day, you realize that you only have 2 apples. So how many apples are missing? That is what we are trying to. So we're going to find our beginning and then subtract our ending. Okay. So the beginning, the unadjusted one, our supplies, office supplies were 2,100. Okay. But now we only have 1,100 left. So we're going to subtract that. So 2,100 minus 1,100, that is 1,000. So we are decreasing office supplies by 1,000. And it's because it is used, is an expense. Whenever something is used, we have an expense. So we're going to look for office supplies expense right here, okay? And then we're going to debit that by the same amount, office supplies spent by 1,000. Okay, good. Now, what do we have to do? Okay, use the above information, okay? Okay, that's the adjustment we did, prepare the year-end close. Okay, so now we have the adjustment, we have the adjustment. Now we're going to do the adjusted one, okay? So after doing the adjusting entry, what are our balance now? Okay, so we're going to start with cash. So we always start with cash. So cash, we begin with this. Did we have any adjustment? No, so we just press enter, okay? Account receivable, we began with this. Did we have any adjustment? No, so we just press enter. Office expense, we began with 2,100. Did we make any adjustment? Yes. We reduce it by 1,000, okay? So that means it's going to be minus 1,000, okay? We press enter. You see, that gives you 1,100 that was left. It says here 1,100 should be left. So we have our 1,100 office supplies. Okay, now track. We started with debit of 280. Did we do anything? No. So we press enter. This is accumulated depreciation. Okay, so that is a credit account. So you go to the credit side. Okay, we begin with this. Did we do anything? Yes, we increase it by this. So that is a current one. Okay, and then we have land. Land is an asset. Okay, we begin with this. Did we do anything? No. So we just press enter. Account payable is a liability. Okay, so we began with this one unadjusted. Did we do anything? No, we didn't do any adjustment. We have interest payable. We began with this one credit. Did we do any adjustment? Yes, we increase it by this amount. So we'll add the increase. So we add increase and we subtract the decrease. Okay, we have long-term payable. We begin with this. Did we do any adjustment? No. So we just press enter. We have capital. We begin with this. Did we do any adjustment? No. We press enter. So this is a drawing. It's a debit account. So you, whenever it's a debit account, you do to debit. So equal to this. Did we do any adjustment? No. So we press enter. This is a credit account. Okay. So we go here. We started with this. Did we have any increase or decrease? No. We have depreciation expense, it's a debit account. So we press enter. We started with this. We had the increase of this. So we're going to add it up, okay? Salaries expense, we begin with this. We didn't have any increase or decrease. So we press enter. Office supplies expense, we started with this. We had an increase of that, so we added up, okay. The interest expense, we began with this. Did we have any increase? Yes, we had an increase of that, so we added and press enter. And then we have repairs track. We started with this. Did we have any increase or decrease? We didn't, so we just press enter. And you see both sides of the equation, debit and credit, are the same. Okay, good. Now let's move on. We have what we call the income statement and the balance sheet. How do you know? Okay, which account to use? So to just remind you, you know your income statement, this is how you write your income statement. Okay, you have your revenue, okay, minus all your expenses. So you list all the expenses here and you have your net income or net loss. Okay, so revenue minus all expenses give you net income or net loss. So that means in your income statement portion, the income statement portion of your trial balance will have only those accounts. Okay, so we will have the account beginning from revenue. So we can color this so you can see. So this portion is your income statement. Okay, so this portion is your income statement. Because you only need your revenue. You only need beginning from your revenue up to your expenses to find your net income. So we're going to copy and paste these numbers. So we have the copy and we paste it with just the numbers, okay? Okay, so this one probably just did it already, but this is what we have, okay? You have this here. So your revenue is this, and all your expenses are these, okay? So you want to find your net income, okay? So you take your revenue, total revenue minus all your expenses because it added up all the expenses here. So you take this, you press enter, you take your revenue, that's your total revenue, minus your total expenses, okay? And then you have this. And then that gives you your amount of your net income of 67,922. Okay, so that means it's not a net loss. So we're going to get rid of the loss here. We didn't know what it was, so we have to list the loss there. So we had the net income of this. Remember, whenever, so how you can do it, just figure it out, is you look at these two. Which one is bigger? This one is higher. So you subtract the smaller from the higher, and that gives you here. If you have this side was higher than this, that means you have a net loss. Okay. So whenever this side is higher, that means expenses is more. So you have a net loss, and that will go here. If this side is higher, that means your revenue is higher. So you have a net income, you put it here. And if you have it on the debit, automatically you should put it on the credit side of the balance sheet. That means it is going into your capital account. If it were to be lost, it will be decreasing your capital account. Okay. So with our balance sheet portion, we're going to do all those things that has to go, the rest. Okay. We're going to do the rest of the trial balance. Okay. So we're going to color, I'm going to color this side so you will see. So I have it up to here. Okay. So that's your balance, what do we call it, your balance sheet. So I'm going to just copy the numbers, the adjusted numbers up to here. So I copy and then I paste it with just the numbers. Remember, use the values 1, 2, 3. And then I paste it here. Notice this one is higher than that. So we need a number here. Okay. So let's see if we'll get the same amount that we should supposed to. Okay. So we need this one to be equal to that. So I will take this minus that, okay, minus the lower one, okay. Is it equal to this? Yep, okay. So what you also can do is you just reference it to this, you just bring your net income here, and that also makes things work out, okay. You just, you just reference it, not that point, right here. You just reference this to this, okay, and then at the end, this one will be equal. So you make that adjustment with your net income, and then those two will be equal. Okay. Now let's move on. Let's have it quickly. So that is how you do your adjusted trial balance. Okay. So if you want to review it, feel free to go back and review it again. Okay. So now we have what we call prepare the end closing entry. Okay. Now we're going to prepare a closing entry. Okay. Now closing entry. This is what you should know for your closing entry. You have probably heard what we call read. Okay. So we have R E I D. Okay. Those ones mean revenue. Okay, so you close your revenue account into income summary. You close your expenses into income summary. You close your income summary into capital. And you close your debit into capital. So when you know your read, you know income summary for the first two and then capital last two. Okay, that's what we're going to do right here. We're going to go a little bit faster than normal. Okay, so we're going to create and what we call closing entry means we want to make sure our temporary account are zero. We are getting rid of our temporary accounts. Okay, so if you are getting rid of our temporary account, we start with our revenue. Revenue is always credit. So because we are closing it, we're going to debit it and close it into the income summary. Okay. So we have our delivery fees expense. That was this one, this here, and we're going to use the adjusted one. Okay. So we are going to debit it in order to get rid of it. So that is the revenue here. We debit it, and then we're going to credit income summary. Okay. So we have it here. So we're done with R. Okay, we got rid of revenue. Because revenue is always credit. If we get rid of it, we have to debit it to get rid of it. We have our expenses. We have to get rid of all our expenses. Okay, and then because we're getting rid of it, it's a debit account. The only time we'll credit it is when we are getting rid of it. So we will credit it to get rid of all the expenses. Okay. So we have all our expenses here. So we put in the numbers there. So we reference depreciation expense. Where is that at? That it is. Okay. And then we just drag this all the way and it will just bring all the numbers for us. Okay. And then we will add up, we will add everything here. Okay. Because we are just debiting income summary the same amount. Okay. Now we go to income summary. We have to income summary into credit, close income summary into credit. Okay. So this one, it's coming from your, what we call your net income or net loss. Okay. That is what it is. You close income into capital. So you close income into capital, you are increasing capital, and then that will go into the income summary. Okay. Or you can just use income summary, you're closing income summary. So what you would do here is you have your income summary and you have your capital. Okay. So what is the difference? What is the difference? Okay. So you will just bring your income. What is your income? You have your income right here. You put it here, and then you reference it. So you have closed it. Okay. So, or what you can do is you can close it by taking this, your income summary increase minus your income summary decrease, and then you have the same figure. Okay. So you can take this minus that, or you can just reference your income and your net income there. Okay. And then drawing, because drawing is always debit, we are going to make it credit. Okay, to get rid of it. And if we make it credit, it's going to decrease our capital. So that will go into debit side of our capital. Okay. So we have, how much was our drawing? Let's go back. We have our drawing here. That was 33,000. Okay. So we're going to reference that 33,000 of the drawing. Okay, it goes into the capital and then we close it. Okay, so that is how you do your closing entry. Remember, you start with your revenue, expenses, income summary, and draw. So you ask yourself, what is a normal account for revenue? It's credit. That means I'm going to debit it. Okay. Let's go to our next one. This is adjusting entry. Okay, so we have this adjusting entry. So what we're going to do, we're going to adjust it. Okay. So pay attention here. You have your cash and this adjusted. This unadjusted and adjusted. So what adjustment did we make? Okay, that's what we're going to try to find. How did we get to the adjusted one? Okay, so I'm going to put it here side by side so we can see. So we had our cash. Cash was 5,000 and it became 5,000. That means we didn't have anything to do with cash. Account receivable was 3,200 and it increased to 32,600. That means we increased account receivable. So we have to make that adjustment. What is the difference? The difference is 600. Okay. If we are expecting to receive money, what does that mean? That means we did a service for someone that we are expecting to receive the money. Okay. So we have an account receivable and also a fees earned. So, okay, account receivable. What's the difference? Okay. The difference is that it is 32,600, but we used to have 3,200. Okay, we used to have 32,000. Okay, so that means the adjustment should be 600. It increased by 600 to get us to 32,600, and we reference the same with revenue, and we got that. Okay, so now we know we are done with account payable, account receivable. Now let's go to supplies. What happened to supplies? Supplies was 3,600, but now we have $100. That means we use something in order to reduce it. Okay, so how much did we use? Whenever you hear use is an expense. Okay, so we're going to have supplies expense of the difference, and also we're going to decrease supplies. Okay, so we're going to have here supplies expense decreasing by the difference here. So we have 3,600 minus 100. Okay, so that is our supplies expense. And we're going to decrease it by that same supplies amount. Okay. Now we're done with that one. Let's move on to prepaid expense, prepaid insurance. Prepaid insurance was 4,000, but now we have 1,400. That means we used it. So it has become insurance expense. Okay. So insurance expense, and then the decrease will go to prepaid insurance. Because if you have used it, then it's going to decrease. Okay. Okay. So prepaid expense. Okay, so this one should be insurance expense. So you can do prepaid expense. Okay. Insurance expense because it was an insurance. Okay. So the insurance we will increase the expense by the difference. So we have 4,000 minus 1,400. Okay, that means we use 2,600 in order to have 1,400. So we just reference that. Okay. What is our next one? Our next one is, let me just go here. Our next one is equipment. Did we do anything to equipment? No, equipment didn't change. Accumulated depreciation, it changed because it was 0 here, okay, and now it's 1,700. So we are increasing accumulated depreciation, and accumulated depreciation, because it's the depreciation, we're going to have depreciation expense, okay. So we have depreciation expense of 1,700. So that's how much we used. And then accumulated depreciation, we are increasing it by 1,700. Okay, so we reference it. The next one is wages payable. Okay, wages payable was 0, but now it's 200. So we're going to do the same thing we do with accumulated depreciation. We're going to increase it by crediting wages payable, and also it's an expense and debiting wages expense. So we're going to have wages expense and then wages payable. Remember, wages payable is increasing by 200. It's a liability, okay, 2,000. So we have our 2,000 there, and we're going to reference it to make it wages expense. Okay, so we recorded that. And then we have what we call unearned revenue. Okay, unearned revenue was, so revenue we haven't earned was 8,900, but now it's 3,500. Okay, so it's decreased. That means we have earned some revenue. Okay, so that means our fees earned is going to increase, and then this unearned revenue is going to decrease. Unearned revenue is a liability, it's a credit account. So if we are decreasing it, we're going to debit it, and then increase our revenue, we're going to credit it. Okay, so unearned revenue, how much was it? It was 89,000. Okay, and then it decreased to 3,500. Okay, it was 8,900 and it decreased to 3,500. So the difference is 5,400, and that is how much we earn. Okay, so that's how you do the adjustment. So with this adjustment, we know that we are done because we don't have any supplies expense, wages expense, and then we have adjusting entry. Okay, so we need to do wages expense as well. Just figure this one out. Okay. So let's see if there's more we will have to do. Okay. So let's see here, we're done with the fees end. So we have our capital. So we know capital, nothing happened. Fees end was 69 to 75,000. So we already did fees end, but you will want to confirm if that is true. Okay. So fees end was 69,000. Okay. 69,000, but it increased to 75,000. 75,000 minus 69,000. Okay, that means we earn. Okay, we earn 6,000. Okay, on fees earned. So fees earned increased by 6,000. Let's look through our journal entry to see if that is correct. Okay, so we'll just confirm that here by selecting. We have fees earned increased by 600 right here. Okay, there is another increase in fees earned 5,400, another here. Okay, so that is 6,000. Okay, that means we don't have to worry about fees earned because we have journalized everything here. Okay, good. Now let's go to wages expense and confirm that. So wages expense increased from 44,300 to 46,300. Okay, so we know that's 3,000 increase, or 2,000 increase from 44,300 to 46,300, and we have wages expense here as 2,000. So we already done with that. Okay, we'll go to supplies expense. It increased by 3,500. Let's look at supplies expense. We have the 3,500 here, so you know you did something right. Okay, so all these are connected to, because when you have one account, you should have the other. Okay, so we have credit account, you should have a debit account. So with this wages expense 3,500 is connected to the wages payable right here. Okay, right here, rather. Okay, so we have those, and then there were 2,600. Also, let's look for insurance expense. We have insurance expense of 2,600. That's when we used our insurance right here, prepaid insurance. Okay, so it become an expense here. We have depreciation expense of 1,700. That is when we use accumulated depreciation. So this one is also connected to accumulated depreciation. Okay, and our 3,500 supplies expense is connected to when we used our supplies. Okay. So 3,500 is actually should go all the way up to supplies when we use supplies. Okay, so you can see the pattern and how they're going. So you don't need to do anything anymore. So let's move on to 13 and see what we have in 13. Okay, so we have a problem here that said this is the company. I don't like this color. Okay, this is a company Lopez. This is the Lopez name of the person, but JVL is the company. Okay. So we have the following, and the following balance at the end of the month before adjusting entry. So this here tells us we are going to do adjusting entry because it says before. Okay, so this one right here, all this information over there. Let's see. Everything right here is unadjusted. Okay, so we're going to do the adjusted. We are going to adjust it by doing adjusting entries or doing adjustment. Just like we did here in this problem, we did adjustments, and then we have adjusted trial balance. So we're going to do that with this as well. Okay. And we know how adjustment goes. We have done it before for you to see in this exercise, but you can feel free and go back and look at them. Okay. So I want to put it side by side so we can see what is going on. Okay. So look at this. This is your account payable. Okay, and your data, everything. But it says supplies on hand at the end of the month is $300. Okay. So if you have your T account, if you were to have your T account, you would have had this thing like that, and then you will have supplies. Okay, that's your supplies account. And then supplies at the end is what we call 300. Okay, so you want to look at your beginning supplies, and when we have supplies right here, okay, supplies was 800. So if we begin with 800 and now we have 300, how much did we use? Okay, that is 800 minus 300, which is 500. Okay, so we use 500 out of 800 to have 300. So that is how you do when you're doing adjustment. They will tell you the end product and you have to find what is missing. Okay, remember you will notice that everything here is just listed in, it doesn't say debit or credit here. Okay, nothing here says debit or credit. If we will do this, everything here, okay, all these figures, none of them says debit or credit. You will have to figure out if it's a debit or if it's a credit. Okay, and we know account payable is a credit. So this one right here is a credit. Account receivable is a debit. Cash is a debit. Consultation revenue is a credit. Equipment is an asset, debit. Capital is a credit, equity. Drawing is a debit. Prepaid rent is a debit because an asset, and then supplies is a debit. Okay, so you will have to figure out if it's a debit or if it's a credit. Okay, let's go. So we know that supplies expense was 500, supplies was used. So we are going to decrease supplies by 500, and because everything that is used is called expense. Okay, so whenever you want to know what term to give to used, when you think of something that is used, think of supplies. Okay, so you will have used means supplies. Okay, great. So let's go ahead and do that. So we have our supplies expense of 500 because we had 800 minus 300 that is left. So we used $500. And then we'll just reference that. So that means we are reducing supplies by 500 and increasing supplies expense by the same amount, 500. Okay. With the second one, unbilled consultation revenue. Okay. Unbilled. That means we did job and we didn't bill it. Okay, we bill it, but it's not recorded. Okay, that's basically what it's saying. Okay, so someone is owing it, we have to bill the person. Okay, so it's on bill, and we are going to bill the person. How do we do that? Remember in my previous one, I think one of these exercises, why did I do that? Yes, bill. If we bill someone, it's account receivable. If someone bills us, it's account payable. So because we didn't bill it, we are going to bill it right now. So that will become account receivable. And if you are billing it, then that means we earn it. So it becomes consultation revenue. So we earn a revenue and we are going to expect to receive that amount. Okay. So I'm going to type in here the account that we will use, account receivable, and then the revenue, which is $850. So we have them here. Okay, great. And then the third one says rent expense for the month is $2,000. This is just straightforward. Okay, you know your rent expense is like that. Okay, and where is it coming from? You have your prepaid rent. Okay, you have a prepaid rent, so that means your prepaid rent is reducing by that amount. So if we have rent expense is going out, that means it's coming out of our prepaid rent because we have bought prepaid rent, so we use later. So once we use them, we have to reduce it. So our prepaid rent is going to reduce while our rent expense is going to go up. That's increase. Okay. So how much is that? $2,000. So we just reference that to this. So we have left and right. Okay. Great. And last one, depreciation on equipment is 150. Okay. Remember, depreciation on equipment. So that means this depreciation is always an expense. And whenever you do an entry for depreciation expense, what is the other account that you have to use? Think about it. Do you know what is the other account that you have to use? Whenever you do depreciation, the account that goes to is the accumulated depreciation. Okay, and now you think about yourself, you think about it, what because depreciation expense is a contra asset, what asset is it contra to? It is contra to equipment. It says right there. It says right here. Okay, so you know it is contra to equipment. Okay, so we're going to have depreciation expense increasing and accumulated depreciation also increasing, and there will be debit and credit increasing at the same time. Okay. So how much is that? That is $150. And this one also increased by $150. So left and right. Great. We have this, okay? And number two, so we prepare the adjusting entry. Number two, it says prepare adjusted trial balance, okay? So after you do your entry, what is the adjusted one? I will again refer to this, okay? You have your beginning, you adjust it, and this is your adjusted. That's the end after you make the adjustment. So that is similar to what we have here, okay? So we are going to see what is our adjusted trial balance after we did the adjustment, okay? So you ask yourself, and whenever you are doing, I'll move this down here, okay, and then get rid of all this stuff. Okay, whenever you are doing your lesson account, always begin with cash. Okay, this one is just mixed, but you have to figure it out. You have to begin with cash always. Okay, so we are going to have cash first. Okay, and then you have to list them as well, and then come with account receivables. Account receivable will be second, and then your supplies will be third, because you're looking at current asset, okay? Asset that can finish within a year. So you start with asset that can finish within a year. Anything can happen to cash. Cash is in the most active account. Okay, so you always begin with cash, and then you guess, okay, account receivable. Okay, we can finish account receivable earlier than equipment. So equipment will be last, okay, in terms of the asset. Okay, so I'm gonna show you the list or type them in here for you to see. So this is what we have. We have cash, account receivable, prepaid, and then the rest, and then also the expenses. Okay. So what do we have with cash? What happened with cash? Okay, we begin. Cash was 432. Okay, so it was 4325. Did we make any adjustment here with cash? No, we didn't make any adjustment. So cash is going to stay the same. And we have account receivable. We started with 750. Okay, let's look if we make any adjustment with account receivable. Okay, we have account receivable here. We made that adjustment, and that is an increase. So we're going to do plus the increase in account receivable. Okay, so that is the adjusted one. And then we have supplies. Okay, what did we start supply with? 800. Did we make any adjustment in supplies? Okay, let's go and look at for it. Yes, we reduce it by this amount. So we're going to make minus So you put your minus here, that decrease, okay? So we have 300, and then it gives you the 300 that is supposed to be at the end of the month. So we have our prepaid rent, okay? How much did we start our prepaid rent with? We started with 6,000. Then did we make any adjustment? Let's look for prepaid rent. Yes, we reduced it by 2,000. So let's do minus is the reduce, the 2,000. Okay, now we have 4,000 left. Okay, equipment. Remember, you cannot reduce equipment. You can only increase equipment. Okay, so let's see equipment. What did we start with? 7,000. Unless you sell equipment, okay, but you cannot reduce it. You cannot use it and finish. Okay, and you will learn as you go ahead, as you proceed in this class. Okay, did we do any increase or decrease in equipment? No, we didn't. So it's going to stay the same. Now accumulated depreciation, should we put it here? No, because it's a credit account. So here they didn't do it, but you have to do it, okay, to show them that you know what you're doing. So you put it in credit. What did we start accumulated depreciation with? We started with nothing because we don't even have it here. Okay, so the equipment was new, it didn't have any accumulated depreciation. So what happened here then? We had 150 here increasing. So we're going to reference that 150. That is our accumulated depreciation. Okay. Account payable is a liability, so it's going to be credit. What did we start account payable with? We started with 350. Okay. Did we have any increase or decrease? Look for them here. No, we didn't do any adjustment. So we're going to leave it like that. Capital, how much did we start with? We started with 15,000. Okay, did we do any adjustment here? No, there's no capital here. So we're going to leave it like that. Okay. And then we have drawing. Should we put it here? No, drawing is a debit. Okay. So we're going to select here and then drawing of 1,400. Did we do any adjustment here in drawing? No, we didn't. So we're going to leave it like that. Okay, revenue is a credit. Okay. How much is our revenue here? Let's look for it. Consultation revenue was 4,925. 4,925. Did we do any adjustment to revenue? So let's look for revenue. Yes, we increased it by 850. So we're gonna do plus 850. Okay, we typing in that is our revenue. Okay, rent expense. Okay, how much did we have with rent expense? Okay, we didn't have any. But did we do any adjustment for rent expense? Yes, 2,000. So we're going to put that 2,000 here for rent expense. Okay, now supplies expense. Did we have any supplies expense? No, we didn't. Okay, it was zero because it wasn't here, so it was zero. And then we had supplies expense somewhere right here. Okay, so 500. So we put it there as a supplies expense. Now depreciation expense. Did we have any depreciation expense here? We didn't, but we had depreciation expense of 150. So we're gonna reference that depreciation expense of 150. Okay. So now at the end, we have these two matching each other. Okay, debit and credit is equal 21,275, 21,275. Great, so that is how you do your adjusted, okay, adjusted trial balance. So remember, it starts from unadjusted and you do the adjustments and then you have adjusted one, okay? And then your income statement, you should only use this portion of your income statement, starting from your revenue to your expenses. And then the rest upwards will go into your balance sheet. So I've colored them so you will see. And in your income statement, if you have it, if you have the difference on debit in the first one income statement, it will go on the right-hand side on the balance sheet. If in case you had it on the right-hand side, it will go on the left-hand side here. So pay attention to that. Those are little tricks that you need to remember. Okay, we have two more and then we'll be done for the day. Okay, so we have these ones here. See, after all adjustments have been made, before account have been closed. Okay, so it's between adjustment and close before the account will be closed. The following balance we're taking from. Okay, generalize. Let's look at what they want us to do. We want to generalize the entries to close the appropriate account. Okay. Now, do you remember what I told you from the beginning? How to close it? Okay. You close it by beginning with doing what we call read. So R-E-I-D. Okay. And then R, you close it to income summary. Expenses, you close to income summary. And you close income summary or your net income, that is your income summary, into capital. And then you close your drawing also into capital. Okay, so remember, read. Okay, now let's go ahead and journalize these accounts. So I'm going to put it on the right hand side so we will see it side by side. Okay, so now we will begin by looking for our revenue. Okay, where is our revenue? Let's look for those bad boys. Okay, so our revenue, we have anything that has revenue attached to it. So this is a revenue. Okay, so we have our revenue. Let me use a brighter pen. So we have our revenue here. Okay, good. So we are going to close that amount. We are going to close this. And because we are closing it and it's credit, it's going to be debit. So we're going to close it with debit. Okay, we're going to do the opposite. Yeah. So if I would do a T account for you to see, this is a revenue. And you had a credit amount of 191,000. You want to make sure it is zero, you close it. So you're going to debit it by that amount, okay, and then the balance will be zero. And because you have debited, you have to put it into an account. So this is the income summary. So you're going to put that same amount you debit here into the credit side of the income summary. Okay, so that's what we're going to do right here. So let's go ahead and do that. So how much is that? 191,000. We close it into the income summary. Okay. The next thing we should do is expenses. Close all expenses into income summary. And expenses are debit. So if we are closing it, then we have to put them into credit, okay, to close them. So this is what we are going to do. Okay, so we have our income summary, but let's look for the all expenses first. Okay, what is our insurance expense? Look for insurance expense. Okay, insurance expense was 1,600. So we're going to put in the insurance expense of that 1,600. We have it here, 1,600. So we put in 1,600, and then salaries expense. How much is salaries expense? That was 46,000 of salary expense. Okay, so we're going to put 46,000 here, and then we have rent expense. Let's look for rent expense and see how much that was. Where is it? Yeah, rent expense right here, 31,400. So we're going to credit it 31,400, and we have salaries expense. Why do I have two salaries? Okay, so this one was supposed to be depreciation. Okay, was a typo. So depreciation expense. So how much was our depreciation expense? Okay, let's look for depreciation expense. That's right here, 13,500. So we have 13,500 crediting it. And our supplies expense, how much was our supplies expense? We look for supplies expenses right here, so 2,500. Okay, so we add everything here and then we put it here. Okay, so you can use the auto sum and select everything here. Okay, and press enter. Okay, so we have it here. Okay, good. Now we're going to close income summary or net income into capital. Okay, so we're going to do it with income summary and then the capital. Okay, so in order to do that, you can use a T account to confirm that. Okay, so but what we will do is we want to close our income summary. So we'll take the increase minus the decrease, and then that will give you an income summary. And then this one will go up here. Will go against that one. Okay, so we have right there. If you want to confirm that this is your revenue and everything here is your expenses. Okay, so you want to know how much your net income is. So everything here is the expenses, that is the equal to here. And then this is your revenue. Okay, so your revenue minus your expenses, gives you the difference. Or if you want to confirm that with a T account, we can do a T account here and then see how that works out. Okay, so let's see, let's do a T account for income summary. Okay, so we have the T account for income summary there, that is right. And then we debited income summary of 19,400. Okay, so now we want to close it. We want to make sure it's equal to 191. Okay, so we want to make sure it's 0 here. So what should we put here? So we will have 0 here, because this minus this will give us a credit of 81,600. So in order to close this 81,600, we have to put the same amount here, 81,600 to close it. So we will have 0 account. Okay. Okay, so that is it for this exercise. Okay, we close it up to revenue, income summary. Okay, now the next thing we'll have to do is do drawing. Okay, drawing is always debit. Now, if we want to close it, we will have to make it credit. Okay, so that will go against capital. So that is decreasing the owner's capital. Okay, so we have that. How much was our drawing? Okay, let's look for it right here. Okay, so gross drawing of 48,000. So we're going to credit it 48,000, and then we're going to debit it into his capital or her capital. Okay, so we have this right here. So at the end, the total should be equal to each other, which is 430,000. Okay, great. Now let's move on to the next one. This could be the last one we'll do. So this is a T account. Okay, so we are going to go through T account. So you have a guy here who we have the journal entry, but these T accounts are not correct. So we are going to correct them. Okay, we're going to correct the T account. So I've made the T accounts here to show you what they will look like. So these are T account. Okay, it's just in the form of a T, so that's why it's called T account. All right, so we have account receivable and revenue. Okay, account receivable. I'm just going to begin with cash. I'll begin with cash on my T account. Okay, so this is my cash, and I have my account receivable. So what is happening to account receivable? Account receivable is increasing by 1,000, and account receivable is an asset. It increases with debit. So I'm going to put the 1,000 here. Okay, so I have my 1,000 over there with account receivable. Okay, now I need a date. Okay, what date it is? It was July. Oh, don't freeze. Excel. Okay, so it was July 3rd. Okay, so I put my date here and then the 1,000 over there. Okay. What else do I need to do? I have to credit service fees, okay, by that same amount. Okay, so I have my service fee here and I'm going to credit it by that same amount. Okay, so I'm going to credit service fee by the same amount. So I'm going to reference it. So we have debit on here and then credit here. And it's the same date, okay? So I'm going to put the date right here on the right-hand side. Okay. Now, what is our next thing to do? My cash is increasing by $500. Okay, so I have a cash $500. Okay, increasing by $500. And what is the date? The date was July 11. Okay, that's the date, July 11. Okay, so cash increase and service revenue increases as well by 500. So I'll just reference service revenue to that 500 and I'll copy the date and put it here on the right hand side. Okay, it's up to you. You can put the date here before the figure, but this one makes more sense because the date is on the right hand side and then these numbers are within the T account. Okay, it makes more sense to me than this one. Okay, and this one is wrong anyway, so let's ignore that. So, well, we're done with the second one. So what else do we need to do? We need to do office expense. Okay, so now office supplies is increasing by 600 right here. Okay, So we need to make that entry, $600. Okay, what was the date? July 12th. Okay, and what account is going against account payable? So we have account payable here, and we're going to reference that to that 600 on the credit hand side. Okay, so we have it here. We're done with this one. And then the last one, office furniture is increasing by 700. Okay, so office furniture, it's a debit. Okay, so we do the $700. And what is the date? July 25th. We have July 25th. Okay, and then we paid with cash, so we are going to reference and reduce cash by that amount, 700. Okay, and then we can reference the date right here. Okay, so we have the date also as July 25th. So this is the most correct one. Okay, this is the perfect one. This is the perfect entry that was supposed to be generalized. Okay, so these ones are wrong. So if it's when you take it from your journal entry to your T account, if it's debit, it has to go to debit. Okay, right here. If this one is credit, it has to go to credit. Okay, you just copy and paste or matching it. Okay. All right. So this is what we have for today, and there are so many ways of doing accounting, and whatever way you choose to do, keep practicing, and good luck on your test.